Good day to all. I'm 𝗪𝘆𝘀, an iFAST research analyst. Chinese stocks struggled to rebound last year, making the MSCI China Index one of the worst performers on the global stage, evidenced by the 11% decline. We believe the market will continue to be shrouded in uncertainties in 2024. The overall confidence in China's real estate market remained at a low level of 93 as of last November. Property investment experienced a year-over-year decrease of 9.4%, with the decline widening month-over-month. However, there are some progress has been observed in house deliveries, with more projects wrapped up amid a demand slowdown due to lower consumer confidence and a shrinking population. China has faced huge pressure from excessive house supply. Economic sentiment, reflected in confidence levels, remains subdued, impacting both consumer and business behaviors. Caution is evident in spending decisions, driven by a challenging job market and shrinking paychecks. Average salaries took a hit in 2023, dropping by 0.4% compared to 2022 on average, a phenomenon not witnessed since 2016. Businesses are also reluctant to make new investments, as evidenced by a decreased credit demand. This underscores the urgency for additional supportive measures to stimulate economic vitality. While there has been recent diplomatic softening between President Xi and President Biden, geopolitical tensions remain a significant concern. The US and its allies are expected to remain a firm stance on sensitive territorial issues and export regulations. Effectively navigating these complexities will be crucial for shaping China's economic trajectory. Looking ahead to 2024, strategic measures are on the horizon. A moderately expansionary fiscal policy is anticipated to support LGFE rollovers and the property sector. Additionally, a more relaxed monetary policy is anticipated to discourage savings and boost credit demand. Given the continuous decline in domestic consumptions, attracting foreign capital emerges as a pivotal strategy for economic revitalization. China's ambitious target of achieving 5% economic growth hinges significantly on foreign capital influx and establishment of new trade agreements. To get a full analysis, scan the QR code or click the link in the description below. Next up, Cyrus will talk about short-duration bonds. Over to you, Cyrus.
Hi, I'm Cyrus, research analyst from the iFAST Bond Research Team. While we saw a robust rally in longer maturity bonds in the closing months of 2023, bonds across different maturities generally delivered positive performances for the full calendar year. In the midst of this dynamic market, we reiterate our strategic preference for short duration over long duration bonds. Contrary to prevailing market pricing of aggressive rate cuts, we project the Fed to maintain rates at higher than what markets are pricing in at the moment. The encouraging news for investors is that short-end yields are expected to remain stable and attractive for an extended period of time. This offers a strategic advantage in a landscape characterized by economic uncertainties. We think it is imperative for a disinversion of the yield curve before we pivot towards a more positive stance on duration, and a growth rebound could also exert upward pressure on nominal yields moving ahead. Given our preference for short duration bonds, our first type of recommendations are for Singapore and US T-bills, which generally offer short duration exposures with very high credit qualities. We also provide some corporate bond recommendations in the subsequent 3 slides, all of which we have covered recently in individual articles. For instance, this slide shows some of our US dollar recommendations covering banks like UBS and Standard Chartered, higher yielding banks like Bank of East Asia, as well as non-financials like Keppel. Now this slide shows our recommendations for SGD bonds with less than 2 years to maturity. Once again, there are quite a number of different names here, including Metro, which you might know for its departmental store, ANZ, and Shangri-La. And finally, this slide shows our recommendations for SGD bonds with just over 2 years to maturity. Now these bonds expose investors to slightly more duration risk compared to the previous slide in general, but we think that this duration exposure is not excessive, while we remain very confident that these issuers will remain stable and are able to pay off their respective bonds on maturity. To get the full analysis, scan the QR code or click on the link in the description below. That wraps up the sharing for this week. Catch us again next week for more investment ideas and updates.